Are you thinking about selling your business? Here are 5 things that will improve the value of your business and the likelihood of closing a deal successfully. This is based on my experience of working in the world of private equity for the last decade. And of course, there are other things that matter, but these are the 5 things that we find really are important when we're doing due diligence on a potential acquisition. I'm Luke Hanson McDonald. Welcome back to Beyond the Family Business Podcast. Let's jump into it. So first, and probably most important, is having a strong leadership team. It's not uncommon that when we buy a business, succession is one of the biggest motivators, so we are immediately looking to replace that key leader. It's often a CEO, owner, operator who wants to step away and retire, and he has no one else that he can obviously hand the reins to. So it's very important when you're selling your business that you think about who on your team could potentially step up or at least play a bigger role going forward. Having that bench strength below the owner-operator is really critical. And equally important is that next layer of bench strength is willing to stick around for at least 3 to 5 years. You're not going to want to go into a business where the CEO and then everyone below them are all in their mid-60s and they're all looking to retire at the same time. That would present a huge risk to any business you're looking to buy. So that's definitely something you want to keep in mind, is that you're not just fostering leadership below you, but fostering, younger leadership that has that longevity. And on a related note, it's very important that the owner-operator is willing to stick around and help with that transition. We often will expect them to stick around for 18 to 24 months. Sometimes we'll actually leave part of the shares, so we'll buy 75%. They'll continue to own 25%. And that leaves skin in the game to know that they still are bought into the success and the future of the business. And then once they've helped us through that transition period, whether it's acting as interim CEO or acting as a board member, then we can comfortably say, okay, we'll buy the rest of those shares, and we know that succession has taken place and they can head off into the sunset. So the second criteria is a healthy financial picture and opportunity to grow. Probably the most obvious one, really. We are buying cash flows in the future. That's how we look at it. And so we want to be able to see you have a defensive moat strategically as a business, and that you have a track record of producing good, stable cash flows. That's something you need to consider timing-wise, is if you're coming out of a difficult period, you may want to wait a couple of years to show that track record of consistent profitability. And equally important, we want to be able to see how we're going to grow the business in the future. So it's really important that you queue up those opportunities for growth, have initiatives that are hopefully already in process, and then the new owner can see those through to fruition. And that's a really key part of coming up with the future cash flow modeling, which is a big part of how you value a business. So the third criteria is clean and accurate financial statements. It's crazy how often this becomes the issue that causes a breakdown in a potential acquisition or sale. Often family businesses will have, a bookkeeper. Maybe they don't really have a professional accountant. So if you are preparing to sell, you want to make sure that you invest that money and have somebody who is preparing your statements correctly and, making sure they're clean, that there's no weird one-off items in there, because financial buyers in private equity are very sophisticated, and they will often find that information during due diligence, and it can be a huge turnoff if something seems like you were trying to hide it. Equally important is that you take out personal expenses. It's not uncommon in a family business that you may have personal vehicles or, maybe family members working that really don't add that much value. That should be all normalized out, because it's not going to be part of the business into the future and really doesn't reflect what the core business, is made up of from an expense point of view. Equally important is if you are not paying yourself a salary, you need to actually factor that in. So if I'm a CEO but I'm being paid through dividends, in the future, I will likely have to put a new CEO in who is actually being paid a market salary. So that needs to be considered when looking at your financials. And one thing that I strongly suggest is that you get a third-party, reputable accounting firm audit, and not a review, preferably actually going for the full audit. That does come with an extra cost, but it will give greater assurance and comfort to any prospective buyer. And that ultimately will mean the process will go that much smoother and you'll have that much higher likelihood that the deal will close. And the fourth criteria is concentration risk with customers and suppliers. And in the case of customers, it really is another way of saying a huge risk around your revenue and ultimately your cash flows. If you have one or two customers that make up 70% of your sales, we don't know those relationships, and so if one of them breaks down and that customer steps away, it could bankrupt the business, certainly have a huge impact on your cash flows. It's really important to us on the customer side that you always try to figure out how do you diversify that set of customers and ultimately your different sources of revenue. Similarly, on the supplier side, it really represents your buying power. If you have one supplier that supplies almost everything to the business, you have very little negotiating leverage when it comes to prices or quantities or anything. And we saw this very much so, post 2020 when supply chains got all screwed up. There was a lot of suppliers that were rationing their customers and more or less prioritizing them as who would get what. So if you have a diverse set of suppliers, it means you have more negotiating power, and ultimately your expenses and business disruption risk is a lot lower. So that's what we want to see. And if you can't diversify your customers or your suppliers, the next best thing is getting into long-term contracts that clearly spell out the terms of the agreement you have and ensure that when the new owner comes in, there isn't going to be any disruption, whether it's on the sales side or it's on the supply side. And the fifth criteria is that you are well informed, well advised, and have reasonable expectations of the sales process. So, this is often something that causes a breakdown in a deal, is that somebody has a very inflated sense of what the value of their business is just because you saw something on Shark Tank or read about a tech company selling for 10 times revenue. Your business may not fit within those criteria. There's very specific multiples based on different industries and the demands for those types of companies. So you need to be well informed to make sure you have a reasonable expectation. And equally important, you don't want to have too low of an expectation because then you might leave something on the table. And the structure of that sale matters a lot, whether it's a share sale or an asset sale, or there's a vendor take back or a holdback. These are all things that you should understand, and you should figure out what you care about and what matters to you. There can be huge tax implications if you do not structure your sale correctly, so you should know this up front. Equally important is understanding the process and the timeline of a deal. It's a common phrase that time kills deals. And if you allow something to drag on too long, or you have unrealistic expectations of how quickly something might get done, like due diligence, that can cause a lot of unnecessary tension, which then can break down the deal. And the best way to be well informed is to hire an experienced advisor. This could be somebody who is a lawyer with M&A experience or an accountant. Any of the big accounting firms have M&A transaction professionals. While you may think as the buyer, I would rather have the seller in the dark, in fact, I think that usually leads to a breakdown in the deal. And I would much rather see the seller have a good advisor who can set reasonable expectations and prepare them for the process that we're going to go through. If they were well informed, if they had an advisor, you'd have that much higher of a chance of meeting all these criteria that we like to look for when we're buying a company. So in conclusion, these are 5 criteria that I've seen time and time again in the world of private equity that help increase the value of a prospective sale and the likelihood of that sale going through. So they're things you should think about, and of course there are many other things to consider, which is why an advisor is so important. But hopefully this has been helpful. Please like and subscribe, and add some comments down below about what other topics you'd like me to discuss in the world of private equity. Thanks so much. Take care.